Talk about the broader markets with futures pointing to a pullback after yesterday's rally. Joining us now is iCapital Chief Investment Strategist Anastasia Amoroso. Anastasia, great to have you with us.
Good to see you.
What's your take of where we are now? We're much through earnings season, but valuations are high.
Yeah, valuations are high. And look, the earnings season, I think, was actually a good one because, despite of some of the results this morning, we have seen more companies beat than typical on average in the last 10 years. And we have seen them beat by a greater amount. So as a result, we didn't end up with a negative 9% year over year earnings number, but we ended up with a 5.2% so far. So I think that is positive. But I do agree with you, Melissa. If you look at valuations, for example, for semiconductors, they have expanded so much. They've essentially doubled since the trough that we saw in October of 2022. And if you look at the S&P, it's trading at 20 times multiple. And then I couple that with some of the positioning. So much length has been added, whether it's the systematic community, whether it's the hedge fund community. And so I worry that the setup is now, sort of precarious going into what is typically a very, illiquid month of August. So you have to wonder, what is the catalyst likely to be to kind of, make for a more protracted pullback? And I think it's yields. It's 4% for now, but maybe it's higher. I think it's worries about the issuance that are upcoming in U.S. Treasury coupons. And I do think it might be some fears that the inflation may actually rise more than people expect.
Yeah, I mean, the base effects go away, so it won't look like a straight line lower as we've seen year on year because just the comparisons are more difficult at this point, Anastasia. But going back to sort of the positioning and adding length, you mean that at one point everybody had been on one side thinking that the worst was going to be ahead of us in terms of recession and market pullback. We saw the markets climb, that so-called wall of worry. And then people started saying, you know what, maybe we won't have that recession. Maybe we should get more bullish. That chase now is on.
I mean, that chase has been fully on for the last 3 months. And, we've now seen a lot of the economists capitulate into the view there's going to be no recession. And soft landing is the consensus. And once that becomes the case, that's when you start to worry. What's also the consensus that inflation is going to continue to tick down until we eventually hit 2.5%. But if you look at the monthly change of CPI inflation, if you forecast that out, let's say CPI comes in at 0.2% month over month, you forecast that out, that we might actually see a slight kink higher in year over year inflation. So I worry that the markets are going to start to worry about that.
Right.
And that right now is not consensus because everybody expects this, smooth disinflationary trajectory.
We're also seeing a rollover in some of the leaders of the market. I mean, if you take a look at Apple and Microsoft from their all-time highs, which were, basically mid-July or so, each stock is down about 10%. I mean, is that we are losing, it seems like we're losing leadership at this point.
Yeah, I mean, look, if you look at the price action yesterday, it seems like, that's what people flock to once again, but they flock to all the other parts of the market as well. But I think there's something to that, because if we are going to be going into an environment where 10-year is not actually going to go down to 3.5%, it's going to stay at 4% or maybe go even higher, especially, again, as we see more and more Treasury coupon issuance, that's not a great environment for tech valuations. And so I think for investors, it's sort of been an easy year. You have some cash and you have a lot of tech. And if you do that, you've had a pretty strong return in your portfolio. But I don't think it's going to be as easy going forward. And it's not just about having tech, but I think it's having some of the sectors that once again can benefit if yields are higher and if inflation is higher. And by that, I mean financials, and I also mean energy.
Does it worry you, though, the Moody's downgrade of the banks, or no?
I mean, some of the weaker ones, of course, had to be downgraded. But I think if I look at some of the stronger banks, obviously there's the fortress balance sheets. But, there's also lending that is in check. There's net charge-offs that are still in check. And there's a soft landing. And by the way, there's a yield curve re-steepening. So, if we worried about this sharply inverted yield curve being so negative and, 10-year falling, kind of depressing lending income, that's reversed. So I don't worry as much about the large banks. And then there's the potential for the capital market activity to rebound, which benefits the large banks.
Yeah. Where does your bond portfolio, what does that look like in terms of the mix that you would recommend to investors?
I would focus on some of the spread product. And, of course, spreads have tightened in high yield, spreads have tightened in investment grade. But I would still look at some of those opportunities because, look, the supply has also shrunk of a lot of those bonds. And so the supply dynamics are favorable and investors are in a risk-taking mood. So they are going to stay long some of those. But I would also say, 5 to 8% yield to worst doesn't sound like all that great in today's environment, but that's why I would recommend investors look at private credit, because private credit, mostly floating rate, and some of the coupons are 10, 11, maybe 12% or higher depending on the product. So I would barbell some cash, some high yield, and maybe some investment grade, but certainly private credit is part of the mix.